Nice to meet you. Nice to meet you. Thanks for coming. All right, thanks for coming. All right, thank you. Nice to meet you. All right, thank you. Thanks for coming. No, go that way.
So the first team, once again, is Blueprint Realty. Timer, ready? All right. You have 15 minutes.
All right. Good afternoon, judges. Good after guests. Once again, we want to thank everyone for coming out, taking time out of your busy day to come down for this presentation. My name is Theophilopoulos.
I'm Stephanie Mall. I'm Elise Williams.
I'm Jeremy Roach.
I'm Jake Broussard.
And we are Blueprint Realty. We're super excited to be here today to present to you our analysis of the opportunity we have at 619 West 54th Street, a mixed-use building, 10 floors, mixed-use office as well as retail, with a really unique opportunity because it's one of only a few buildings on the island of Manhattan that's zoned for commercial lab use. Just an overview of what we're going to talk about today. We're going to take a look at the property as well as the market. Then we're going to dive a little bit deeper into the partners as well as the agreement that was offered between the both of them. Then we're going to take a look at our valuation and underwriting analysis, the return on our equity. Then we're going to address some opportunities and challenges before we present our final recommendation. Before we jump in, though, we do want to address our recommendation. And while we do feel that the opportunity is poised for success, we ultimately want to pass on bringing it to ISTP just because it really does not fit their investor profile at all. Alternatively, we want to market it to some of our other clients who are maybe looking for something, maybe looking for a little bit more aggressive of an approach with a value-add repositioning project. Because we feel that it will still have the opportunity to drive some strong risk-adjusted returns, and we also want to build a strong relationship with Steinbrenner Properties. They're one of the premier developers in the city of New York. So we feel that we have some great opportunities to kind of pave a path for some future opportunities down the line. But to kick things off, I'm going to pass it over to Steph to talk about our property.
Thank you, Theo. So the property is a Class B building located in Midtown West Manhattan. It was built in 1930 and is roughly 317,000 total square feet. In addition to this, there is 15 on-site private parking spaces. This is something that we feel is rare in Manhattan, but also makes our property super unique. The building also has 3 main elevators and 2 service elevators. It is currently zoned M2-4CL, which allows for manufacturing, commercial, and lab space use. In addition to this, there's also been $8.1 million in CapEx improvements since 2013. Some of the improvements, just to name some, are a cooling tower and boiler. Both the zoning and the capital upgrades we feel is super important and will help when repositioning this property for lab space. Now to get into the tenants. So the building is currently 76% occupied. Volvo is on the ground floor, and half the ground floor is vacant, followed by the 3rd completely vacant and the 10th completely vacant. New York Stem Cell Foundation is one of the new tenants, and Roosevelt Surgery occupies 2 floors, and we feel that they're super important to note because they're a credit-based tenant and they're backed by Mount Sinai West. I would like to pass it on to Elise to talk about the market overview.
So as Stephanie mentioned, we do have a lot of tenants already occupying our building that mainly fall into the category of a medical office building or a lab, so that would fall into the life sciences industry. So I'm just going to give a brief overview as to why people are getting really excited about this industry right now and improving their venture capital investments and overall investments in the industry. So first I'd like to start with 3 main trends, mainly just that rents remain stable through economic downturns or recessions, and that vacancies remain low. And employment remains growing. The reasons behind these mainly are the growing and aging populations which support the life and sciences industry, also software advances and digitized data allowing for spaces to get a little bit more creative. And then lastly, to combine the two, is just less costly solutions and consolidating the space to make it a little bit more collaborative. All right, so now let's just get into the property a little bit more and see how they can work their way into this industry and grow within that. So our property, 619th West and 54th Street, they have a transit score of a 94 and a walking score of a 93 due to their great linkages. And just so we know, the property is located on the cusp of Hell's Kitchen and the Upper West Side. So just a brief background on both areas. Hell's Kitchen obviously has a great growing population and a relatively high median household income, and the Upper West Side follows. They also have a relatively stable and growing population, with over 20% of that population being over the age of 65. And then their median household income is even higher at over $120,000. So now that we talked a little bit about the submarkets, we can look at the property a little bit zoomed out. So as you can see, the pin on our property is there. And if you look at the map, you'll be able to see great research institutions highlighted in yellow. Those are to name a few, but there are 11 total in the vicinity. And those are also a few great hospitals and medical centers that kind of prove that point of great linkages to kind of supply support and talent in that hub. So since we mentioned that we're looking to add the medical office space and that we already do have that as well as lab space, we'd just like to show how popular the real estate is in the Manhattan market. Manhattan's market overall is really fantastic, but medical offices and lab spaces especially perform very well. Especially with lab spaces, there is currently 100% occupancy due to the constrained market due to zoning. So then New York as a whole, we just kind of want to tie it together here for that market overview so that you can see those parallels between those trends explained upon earlier and here. So as you can see, the employment rate and the vacancy rate are even better. So the employment rate's even higher and the vacancy rate is even lower. And just kind of point to that funding that's increasing in the overall industry is that New York City is the second highest metro recipient of National Institute of Health funding in terms of metro areas. So now I'll pass it over to Theo, and he'll break down the deal for you and get into detail on that.
All right, so now we're going to take a quick look at the partners that are going to be involved with the deal. First, the one who's going to be fronting the most equity, as well as our client, is the Iowa State Teachers Pension. They've got over $60 billion in assets diversified across a bunch of different asset classes, with about 8 to 10% allocated directly towards real estate, which is about a $5 billion figure. One thing we noticed that was pretty interesting is that all of the real estate assets are managed by Safe Harbor, which isn't ERISA compliant. Obviously, that's a concern more for them than it is for us, but we thought it was something interesting that we'd like to note. Taking a look at the target deal metrics, because being a pension fund, they try to lean more towards the conservative side. So they target deals where they front about $50 million worth of their own equity. They target those gateway markets, core plus properties, about 50% leverage, and then they target a 7 to 11% return. The general partner, the party bringing this deal to the table is Steinbrenner Partners. As I mentioned earlier, they're one of the premier developers in the city of New York. They've developed and managed over 20 million square feet of best-in-class assets over the past 35 years. And they've recently launched their own $200 million discretionary private equity fund so that they can start investing in deals just like this. Once again, I also want to mention that we've had some rapport with them for the past 2 years, but no deals have really come from it. So we feel that, one, that shows that they might have marketed this deal to some of their other partners, some of their general clients, with to no avail. But then that also gives us the opportunity to come in, kind of save the deal, and build, again, a good relationship that will lead to more deal flow in the future. Taking a look at the partnership agreement that they offered us, again, as I just said, we personally are in a position to actually save them with this deal, so we decided to provide a counter offer that was a little bit more aggressive. First off, we wanted to nix the asset management fees. Our clients are already paying asset management fees to Safe Harbor, so we really don't want to have to make them pay any more. We also felt that the property management fees and the LCs were both a fair bit higher than market rates, so we wanted to bump either of them down, and that came in the form of shaving about 50 bips off of the property management fees. And then finally, first off, I want to apologize for the formatting, and it got messed up when we submitted it in PDF form. But the largest part that we wanted to overhaul was that promote structure, with the largest change coming in that first hurdle, changing that 6% IRR up to an 8% IRR. But now I'm going to hand it over to Jeremy to go a little bit more into the valuation and underwriting assumptions.
Thank you, Theo. So for our base case underwriting, we used a 4.75% exit cap and also a 5% market vacancy allowance. And that got us about an 8.7% IRR at both the property and client level. So here's just a brief breakdown of our cash flow for our base case. And as you can see, we executed a 5-year hold. And we were also given 2 debt options, and we chose the insurance company loan, which was a 60% LTV loan at a 5-year term. And we also chose to leverage our TIs in both year 1 and year 4, as those were our 2 years with our highest TIs. And a little bit, we presented a downside base and an upside case. So in all 3 cases, we had Volvo vacating on the ground floor. And we envisioned a small grocer like a Trader Joe's going in there. And in the other vacant spot on the ground floor, we thought a walk-in clinic would work very well. For the downside case, we had a medical office going into that vacant 10th floor and lab space going into the vacant 3rd floor. And for the downside, we also had RK Bridal and John Jay renewing. And with similar for the base case, we had medical office going into the vacant 10th and labs going into the vacant 3rd, as well as John Jay not renewing and putting a medical office in that newly vacant 6th. And finally, for our upside, we went a little different. We would move Rogeson from the 8th floor down to the vacant 3rd floor, so they can have the 2nd and they just signed a lease for that 2nd floor, and we would add terms for the new 3rd floor lease to match what they just signed at that 2nd floor, so they can have 2 floors right on top of each other. And we also underwrote RK Bridal not renewing, so this would allow us our top 3 floors, 8 through 10, to be vacant, and we would turn all those into lab space, which would give us almost 100,000 square feet, which would give us a unique place in the market to market preferably to one client. So a little bit more on our returns. So like I said, we used the upside, a base, and a downside. In our base case, we used a 4.75% exit cap, while the upside we used 4.5% and downside 5% exit cap. And as you can see, we got about a 15% IRR on the upside, about a 4% on the downside, and again, 8.8 on the base. So now I'm going to hand it over to Jake to talk about some more of the opportunities and challenges for the property.
Thanks, Jeremy. So we've already talked about a lot of great things that have to go on with this property. There's a couple other things that we couldn't necessarily capture in our underwriting. One of those was a proposed rooftop deck as an amenity for our tenants to kind of differentiate our building, give them views of the Hudson River, and allow us to market that to maybe the 8th through 10th floor that Jeremy talked about if we put a lab on all 3 floors there. Just something to allow our tenants to really feel like this space is special. Some of the advantages on the right here, first mover advantage, we've seen that life science spaces kind of start in clusters, and we want to be one of those first clusters. And we think that in New York City, the construction's only going to continue with this proposed Life Science New York City tax credit initiative, which is $1.1 billion in incentives from the state and local government, which means that we think construction is going to continue. We want to be one of the first movers on this construction. We want to build an ecosystem of life science space around this building so that we can really be one of the main buildings in the life science community in New York. Real estate investment activity in the life science sector has increased recently. We think this is well supported by Blackstone buying Biomed Realty, which they did at a 10% premium to the price of their stock that went on that day of closing. And it's really changed from a niche asset to a more accepted real estate asset that institutional money is starting to become interested in. And tenant overflow from Cambridge and Boston is important to the New York market, as well as some of the pharmaceutical companies and life science companies that are already in New Jersey that we think we can entice being on that side of the Manhattan Island. Moving on to some risks and our mitigations to those risks. There's high cost of building out lab space. We underwrote about $300 per square foot in our base case, but we think as we build more lab space in one building that there's an economy of scale to that and we can get that price down the more floors we do, and it also would offer tenants consolidated space all in one building so they don't have to move between each building for different labs. And even with that $300 per square foot, the leases are still accretive to the value of the building at the per square foot cost that we're buying it at. So that's why we still think that the upside is to add as much lab as possible. The performance of the life science market throughout downturns is important because we're 8 years removed from the global financial crisis, and I think it's not going to just keep going up from here. So there's going to be a downturn at some point. It could happen in our 5-year hold period, but the life science sector performs well in that, and we think it's a good way to hedge against that. And talent could still migrate to Cambridge, but we're confident New York will be able to compete with Cambridge as the tax initiatives and other incentives from the state and local governments start to take hold and build this community. Moving on to recap our recommendation, we don't, as Theo said, we don't think we should take this to ISTP. It doesn't fit their profile. They're looking for core and core plus. We've been bringing them investments that Mary Pope, the new CIO, has been sending back to us saying this isn't what we want. We want to make sure that they understand that we know what they want, and we don't want to send them a deal that isn't exactly what they're looking for, because we want them to have confidence that we're the right advisors for them. But we also think we should bring this to our other clients who are looking for value add. Because if you want a value add, where better to do it than Midtown Manhattan? That's one of the best places in the country to be doing something like this. So we think it's a great opportunity to bring to our clients a value add opportunity and build a relationship with Steinbrenner, who's one of the biggest developers, best known developers in the city, where we can save a deal for them and negotiate an advantageous advantageous partnership agreement, and using our leverage as the savior and the capital in this short amount of time. Again, there's a strong life science real estate market. We have unique zoning at this property, and we think that's going to drive strong risk-adjusted returns for our clients. And with that, I'd like to open up the floor to any questions.
Hello, can you hear me? Okay, great. Good presentation. Thank you very much. I guess my first question, I'll start with the last statement that you made. You said that this is a good value add deal. I agree that there's value add aspects of the asset, but how is an 8.8% a value add return? Isn't that more of a core return, even though you're taking the risk on the value add side?
Yeah, well, we think you could leverage it up a little bit higher and boost those returns more. We used the 60% LTV loan, and we think, and we used the 70%. We got higher returns, around 9%, and we think if you even did more debt than that, you could boost those returns higher. But our clients are more pension funds, so we wanted to keep the financing on the less risky side when we're presenting it to them, and we think they would still be happy with an 8.7 return, with the upside being 15.3 if we could bring as much lab as we think we could into this property.
Did you guys visit the property?
Yeah, I actually had a job interview on Friday in the city, so I had some time to kill before I went to got my train home, so I managed to get a chance to get over there and walk around it and get a feel for the property. The transportation in the area, a little bit of a concern, about 15 minutes from the nearest subway station, but there's a bus station right on that corner if you want to rely on buses, but as a New Yorker, you're not really going to be relying on those buses. You're more of a subway person for sure.
And any comments on the character of the neighborhood, of the new developments in the neighborhood, and how that might positively or negatively affect the property?
Yeah, so I think that it's definitely a unique area. We haven't really addressed something like this before in any of our cases, but we feel that, especially being around the car dealership area, it creates a nice strip effect, and that the walkability of it is great. We planned on putting in a grocer, something like Trader Joe's, on the ground floor, a walk-in clinic or something, so we'd be able to create that walkability, make sure people are coming to our property and making sure that the walkability, again, is great.
Thank you.
Yep.
Nice shot.
I think we had a question, don't we?
Wanted to just ask how you thought about the right hold period here. Obviously, it matches up with the financing maturity that you selected, but how did you think about that?
How did we decide how long to hold it?
Right.
Well, it started with the financing and with what our ISTP wanted to hold, and as we got more into the analysis, we had built it around this 5-year hold period, but obviously with these lab spaces and these high build-outs, we're going to be signing tenants to at least 10-year, hopefully 15-year leases. So we feel that once it's stabilized, the hold period could keep going further and further, but we just didn't get to do that analysis.
And the other question, based on your business plan for the leasing, so moving it more toward lab, how do you think that impacts the yield? So you're going, you have a going-in yield of 3.3 and an exit yield with a fixed expansion, but how does the tenant mix play into that?
Well, I think if we're able to get lab space at a significantly higher rent than, say, a medical office, I think that plays well for our reversion year NOI, and so I think that would maximize our reversion sale value.
And I think if we put lab tenants in who are high credit versus some of the seed funding like startup biotech companies, that would also help our cap rate and our yield on the way up, because an investor is going to look at someone like a Pfizer in the top 3 floors a little bit different than some 3 floors separated that are all like different seed fundings that have sprung up from like Mount Sinai and then Rockefeller University, stuff like that. So it depends on the credit and the balance sheet of that tenant as well, I think.
So, one of you brought up the idea of clusters with lab space, and I think that was a really good point, and you suggested that you would want to be the first mover. Did you evaluate other clusters around the New York City area?
Right now, there aren't too many clusters already located. As Jake already mentioned, there is a state and citywide initiative to kind of bring New York City more up to like the hub spectacle, I guess, of lab and medical office building spaces. So right now, there is a campus kind of in the works with the governor. They're trying to build it more towards Midtown Manhattan as well, but more on the east side more so. But that funding overall is getting allocated to the metro area, and especially since we're already in place, we already do have some of those tenants that cater to that area. I think our marketability is just kind of boosted up. As we also mentioned, the market trend is to keep spaces collaborative and consolidated. So kind of branding New York as the new place to be, especially with those new developments, will definitely give us that first mover advantage because we are already kind of holding a stake there. It's kind of, if you want to mirror it with the Boston-Cambridge area, they're really hot in the market right now. And the steps that New York's taking, such as the new funding, mirrors their initiatives that got them to where they are now.
Right, yeah, I was just wondering if you noted any other little areas or pockets in New York, Brooklyn, Long Island City, any other areas that were not Manhattan.
I would have to look. Yeah, I would have to look more into that. We more so focused on the metro area to see what they could develop and the potential there. But I'm sure there's definitely more information that we could look on in terms of like other boroughs or Brooklyn. And also the state funding too might also be helping those areas as well.
Can you guys talk about? I'm sorry. Can you talk about the rental rate assumptions that you're using a little bit, and how you handle the in-place tenants? For instance, you're saying that the retail rent is $68. I think the comps in the market are less. And how are you handling the rollover as you're marking up these rents across your existing tenancy?
Yeah, so for our downside base and upside, we handled it differently. So like for our downside base, we had our 2 in-place tenants that roll over, RK Bridal and John Jay. We had them renewing in our downside. In our base, we had John Jay vacating, but RK Bridal still renewing. And then our upside, we had both John Jay and RK Bridal vacating and putting in lab space in those vacated.
You assuming those are gross or net rent?
Retail's net, everything else is gross.
Yeah.
And speaking to the comps, we did, outside of those comps, we did research as well, and especially for retail, we found stuff that was a little bit higher, so that's when we got a little bit aggressive on the upside and priced in some of the research that we did outside.
Did you put in extra TI more than 45 to build out the retail space?
We did not on the upside, no.
Or in the base case?
We gave more free rent, I believe, and we underwrote more downtime so that we could find a tenant that was willing to pay maybe, and we could negotiate with them that way.
Yeah, so for the downside, we included more free rent and more turnover times, and for the upside, we included less free rent and less turnover time.
And what were your rental rate growth assumptions and your expense rate growth assumptions, as well as real estate taxes?
Yeah, so we, again, trended those for mostly downside and upside. And so 3% rental growth, and I believe we used 3.3% expense growth.
We grew variable expenses per occupied square foot, though we didn't just grow our variable expenses. And then we also used base year stops on all of the gross leases.
Just a question on the retail side.
Yeah.
Did you think about other uses for that retail space that might complement where you were going with the building in terms of, more life sciences?
Yeah.
Lab spaces?
No.
I mean, I'm thinking like, is there like is there an assumption that maybe there could be a WeWork use or something else that maybe collaborates a little bit with the tenants in the building that could make the building more attractive?
Yeah, I think that's, we thought about that for the upper floors, maybe the medical office, but for the ground floor retail, we wanted kind of a traditional retail. So we're thinking if we couldn't do like a Trader Joe's or a walk-in clinic, maybe a Walgreens or a Dwayne Reed or something, and that would tie in with our building pretty well.
By walk-in clinic, we mean like urgent care, small medical office space on the ground floor as well.
Was that based on your analysis of what's in the market currently?
Yeah.
And also too, just to contribute, I know Theo said that in terms of subway linkages and things like that, it's not as strong, but the walkability is a really great selling point for it. So a place that's on the first level, that's visible to the street and visible to the public, a place where you can stop in and kind of see something where everybody can go in, was something that we felt was important for the first level.
Can I just go back to my first question? So
Yeah.
if we're the pension
Yeah.
and we're looking for 7 to 11% returns,
Mm-hmm.
put aside my belief in whether it's value add or not, it hits
Yeah.
our threshold.
Yeah.
So why aren't you recommending it to us to invest in it?
Well, that's because we've brought you deals already, and you've been turning them down, and we feel that bringing you another deal that we don't think is going to fit your investor profile is going to give you less confidence in our ability to pick a deal that you're going to feel good about and that you're actually interested in.
So what is it about this deal that you don't, because it's hitting our returns according to
Yeah.
your base case, so why won't it fit our investment profile? What is it about your analysis of us
I'll
that
take
doesn't
it.
align?
A lot. Oh.
Okay.
I was just going to speak like a little bit to the case too. If you reference like their comparable properties and deals that they've done in the past, normally Class A, they're leasing up from higher occupancy rates that they've already had, so the property they'd most likely view as a little bit more risky. And then outside of that, kind of more geared towards the numbers, but like the debt structures that were offered, that we were kind of dealing with were a little bit higher than they were more comfortable. So we didn't want to kind of strain that relationship too hard by offering them something that when they take a look at with an already partially strained relationship is going to be something that they want to put off the table at first glance.
I also say their equity size is usually around 50 million, and for our deal it's about 80, and also their leverage is 50%, and we use a 60% LTV. So we think it wouldn't fall within their very conservative pension funds, and we think having the leverage and the equity size are two big pieces that don't fall within their thresholds, and I think that's why we would not market it to ISTP.
Okay.
Did you figure out in your model whether the premium you got for the lab rent was worth the $220 more you had to spend in TI?
Yeah.
So why didn't you do it just all lab or all non-lab?
Well, we had tenants already in there with 5-year renewals, so we felt that it would be disingenuous to assume that all those tenants are going to get out of the building in our base case, and to just say that we'd be able to make all of that lab space. So that's why on our upside we targeted as much lab as we thought we realistically could get to, but on the base case, just to save ourselves from not being able to hit returns because of other tenants renewing and stuff like that, we didn't think that it would make sense to do all lab in the
The lab
base.
space was accretive to your model.
It's very accretive base when you take out the leasing commissions and the expenses and
Okay.
leasing.
10 minutes of questions. We have to stop at this stage. Thank you very much.
Thank you.
Thank you.
Thank you.
Good job. Thank you. Really good job. Thank you. Thank you. Good luck. Thank you. Thank you. Thank you. Great. Thank you. Good job. Thank you.